Greetings. Hey, this is Gabriel Tim, the CEO of DC Financial Group. Hey, we want to thank you for joining us on this webinar. Hey, the great thing about tonight is you got to put your checkbook away. We don't want any money, anything tonight from you. What we're here is we're just here to educate you. I got a phenomenal gentleman tonight, Mr. Dominique. He's the president of Better Wealth, where he leads with a mission to help people take back control of their money and live life more intentional. A former Division I athlete, a professional wide receiver, Dominique has a short stint in the NFL before transitioning to the field of financial education and personal development. At Better Wealth, he combines his background in leadership, coaching, and communication to guide a growing team and communication focused on wealth and efficiency, strategic life insurance, long-term financial transformation. Dominique is also a speaker, entrepreneur, also sharing insights on intentional living legacy, building wealth, breaking free from financial stress, whether it's through keynotes, podcasts, one-on-one mentorship. Dominique is committed to equipping people with the tools and the mindset to live wealthy in every area of life, starting with clarity, control, and confidence.
All right. Well, today we are going to do a special presentation. And from a quick overview perspective, what you can expect for today is I am going to share with you one of the best ways to store, protect, and use your money throughout your entire life. And before we get started, what I want to do is I want to do a quick disclaimer. You know, it's just something that we got to do being here in the United States. It is unfortunate, but it is true. Not a financial this is not financial advice, not legal advice, no advice specifically. This is specifically for education purposes, for you to essentially choose how you want to move forward after you learn this strategy. And for you guys that are watching currently, this is also a disclaimer that you maybe feel like at the end of this that you just drank through a fire hose. It's a lot of information. Some of you may have never heard of this strategy before. Some of you may have heard of this once upon a time. But if you're not too familiar with it, it's going to feel overwhelming. It's going to feel like a lot, but that is okay. Here's a resource for you now, after. We have a team of individuals that can also help you to consistently learn this stuff. We also have books. We have content. We have YouTube channels. We have a Better Wealth YouTube channel, an And Ask YouTube channel. And, you know, just to give a little bit more context about who I am and who we are as a company, my name is Dominic Rufran. I am the president of Better Wealth. I run and operate the company. We have been in business now for roughly 7 or so years, and we operate in all 50 states. Our mission is to help people live an intentional life by bettering their wealth. And we just decided that we wanted to help people take more control of their finances and do things in a better way. And so key takeaways of some things that we'll go over today is we're going to talk about a multi-dimensional benefits of overfunded versus typical whole life insurance, and essentially the core benefits that life insurance has and how it could be utilized in your life for when you pass away, and also how you can use it today. Because what a lot of you are used to is just typical traditional life insurance that when you die, a death benefit gets paid out. But not a lot of people talk about the other benefits that come with life insurance, how we can use it more to grow your wealth, control your wealth, have more options in the future, whether you're an investor wanting to have for retirement, whether you just want to save more, be protected. There's a lot of really incredible benefits that come when you use life insurance in a very unique and specific way that we have essentially specialized in, that not many people in the world know how to utilize. And so with that being said, our number one goal is to help you live more intentionally. And so with that being said, we are going to dive into it. So when we're talking about this concept of the and asset, life insurance, overfunded whole life insurance, they're all kind of synonyms. Some of you may have heard the word infinite banking, and we have coined this concept, the and asset, because it is a asset that is multidimensional. Okay. And so first and foremost, this is not an investment. It is insurance, right? So I want to pre-frame it. A lot of presentations, you'll see people talk about this concept. They'll talk about the cool benefits, the marketing around it, some amazing people that have used it, and they'll wait to the very end to talk about that it's life insurance. I want to just put that objection obstacle up front to let you know. A lot of people, when they hear it, they get angry. They're like, hey, life insurance is a scam. You hear Dave Ramsey, you hear other people talk about it. I understand that. And I think that there's some truth around it, but a lot of it has to do with some of the traditional life insurance that has been sold and how it has been sold over past history. And so today, I want to talk about the real benefits of how we design it and how it can work in your life. And what we have coined the and asset is because this is a asset that can be used and not or. So when you think of a phone, your phone has many different tools on it, applications. It's got the weather app, it's got a timer on it, social media. Specifically, if you start looking at it from a timer, right? I can go down the store, I can buy a timer. That's a one thing. That's a timer, or I have, a compass, right? They're like separate. You don't get to use them all simultaneously. If you're on a phone, it's an and concept. I got all of these benefits bundled up into one. I got my texting and I got a calling. I got calling and I got social media and I got my banking. This is the fundamental principles of how life insurance works when it's set up and designed in a way to help benefit you living today and also when you pass away. It's an and it has got many, many different characteristics that allow it to be super flexible. And so who has used this and who knows about it? Well, pretty much any president that has ever, walked the earth, depending on, it doesn't matter what side of the aisle you're on, left or right, all of the people that are in office, politicians, they've all used this. They know about it, and why have they used it? It's because it's essentially what the wealthy use, right? Such as banks. Banks have billions and billions and billions of dollars in life insurance, specifically called bank-owned life insurance, because they understand the power behind it. They understand the benefits behind it, and they understand that when set up and used in the correct way, it is something that can add tremendous value to their business and also to the people that they're serving. And so you have corporations that's called company-owned life insurance. All these companies use it. So you start to ask yourself, okay, if you have politicians, presidents, banks, like all of these different companies, high-profile people using this strategy, why don't more people talk about it? Well, there's a lot of people that have used it in past history, but I think it's become less and less sexy and less popularized because there are other things such as the 401k or, Wall Street that have essentially came in and said, hey, we want control of your money. We want to take your money and do something different with it versus allowing you to be the one in control. These companies understand the power of control and keeping money in their hands and them choosing what they want to do with it. And so essentially, banks, they tell you to give them their money, but what they're doing is differently what they're telling you to do. And that's really the conundrum that we're in a lot of things in society is people say one thing, but they're doing something completely different behind doors. And that's what we want to uncover today. And so Walt Disney, he used it to start Disney World. If it essentially was this close to going under, but he was able to take a loan against his policy to essentially get it up and running and move forth. Ray Kroc with McDonald's, helped him tough times, go ahead and build, expand McDonald's. Another person has utilized this concept and strategy. And then there's some very, very smart people that have also studied life insurance in a way that is not just, these high net worth, high profile people are using it, but they've also done the studies and shown that in using it in retirement planning is one of the most powerful tools that can be used in conjunction with other things as well to help you have more money in the end. And so here's a book by Wade Pfau, who's a PhD, who's done all the research around it. Here's another book by a guy named Tom Wall, Permission to Spend, super smart PhD level researcher. And then again, we have our book called The And Asset. My partner, Caleb Williams, he wrote it. And again, if you're watching this and you're getting this through the email list, through connecting with Gabriel, you have the ability to connect with us and we'll give you a free copy of the book as well. You just have to reach out and say, hey, I'd love to have a copy. You'd love to read it. We'll send you a book. And that is on us as well. But in my opinion, this is one of the most simple ways to understand this concept. And, even the title says a secret way to save and use your money at the same exact time. We call it the secret way just because not a lot of people know about it, but this gives you the right? You can save your dollars today and also use it in the future. And so I think it's a very good read. Really take 2 to 3 days to read it. And again, we'll give you a free copy if you'd like to read it. And again, I try to overemphasize this concept of multidimensional, and I want to try to do it as many different examples as possible so you can really have it just sink into your mind of, okay, he talked about the phone being multidimensional. He talked about the flexibility, and this Swiss Army knife is the same example, right? You have one knife. Yeah, you can have a really long knife that's like really long, strong, big, and it could be, just imagine a financial tool of like multi-vesting real estate. Like that's essentially a long knife. Or private equity, that's a sword, right? You got bonds, you got this little tiny, knife over here. Imagine a tool that is multidimensional that has multiple purposes, right? Some of those other tools that I said, they are just meant for growing your wealth significantly or protecting your wealth from a conservative perspective. Imagine a tool and an asset that allows you to have multiple purposes, that allows you to grow your wealth, protect it, save more, have tax advantages. It essentially allows you to have options in the future, whether it's cash flow, whether it's real estate, whether that's opportunity funds. We're going to talk about all that, but this is that tool, this tool that allows you to have a multi-dimensional use. And this is why we call it the Swiss Army knife of financial products. And here is going to be, I think, one of the most powerful visual representations of this. It talks about this tool specifically, the benefits, and then these plans up top, right? You get your 401k, Roth IRA, savings, and life insurance. And we're going to mark them on red, yellow, green on, is it safe? Is it easily accessible? Is it competitive growth? And you'll be able to see and compare them side by side. And so first line is safe. Is it safe? Well, anything that is typically in a market-based account, it's got tons of volatility, right? So you get ups and the downs. It grows, it comes down. So it gets red for 401k, Roth IRA, savings and life insurance. It is safe. It's got guarantees in it. Can't go down. There's a lot of really powerful things around the safety around it. Easily accessible. You can see here, when it comes to like a 401k, you have to wait until you're 59 and a half. Savings account, you go right down the street. Life insurance, you can use your money from a liquid perspective within 24 hours to 5 days, essentially, from an easily accessible standpoint. Competitive growth, you'll see that life insurance actually has a yellow, and the reason why it's yellow is because this isn't the sexy investment like the private equity, the angel fund, gets you a gazillion % return. It gets you a conservative growth rate. And over long periods of time, it's extremely powerful, the amount of growth that it can have. We like to stay on the conservative side. IRR, which is essentially dollar you put in, dollars that you get back from a growth perspective, not rate of return, right? Because you have to remember that if I have $100 and then my account gets cut back 50% and it goes to $50, well, if I get another 100%, right, that gets me back to $100, right? It does not if I grow by 50%, I'm not getting all the way back to 100. So you need more on the upside than you lost on the downside just to even to break even. And if I did that calculation where I lost 50% and then I went back up to $100, right? That is actually technically, if you average it out, at 25% growth. And I think that's where rate of return can be misleading sometimes. And I think it's important for us to just actually look at the internal rate of return in a lot of these financial investments and vehicles. Because it's the true dollars that we have access to and we can use, not what is the fancy high number that's on a piece of paper. And so even when we're looking at it from a tax, when we start looking at it from a taxable perspective, there's lots of tax advantages. So we essentially can get even higher return in theory because it's about the amount of money that we can control, the amount of money that we can use. And when you don't have to pay taxes on this, which you don't when you use it correctly, that's a huge, huge tax savings, right? A 401k, when you get to the end, when you start taking money, you're going to get taxed at your income rate. So that could be 20, 30% right off the riff of the total growth that it grew by. Fees, getting ahead of myself. So we'll just actually, because there's fees on this. So when we actually go to the next phase, leverageable, here, I would actually put some of these, in theory, a 401k, probably a yellow when I think about it, because you technically can borrow. You're not borrowing against it. You're actually borrowing from it. And it's a big difference between life insurance. You're actually borrowing against it. So the collateral, it's being used as collateral. It stays put while you're using the dollars. But using life insurance to leverage, you can use it to buy anything you want. And usually it's things that are producing asset producing activities in our mind is how we like to use it. So real estate, business, index fund, Bitcoin, you can use it forever. I've used it for real estate. I've used it for crypto. There's multi use cases for how people want to use and leverage these dollars. And so if you want to think about how to not have to borrow money from a bank or borrow money from a lender, and you want to essentially have your own storage of capital that you can control and utilize whenever you want without credit checks and paperwork and all these other things. Well, this is an incredible tool to allow you to do so. And for real estate investors, it is a super powerful tool that allow you to leverage. There's guarantees inside of life insurance, and obviously your savings account, that are there. Savings account, $250,000 of protection, just from a standpoint. For 401k, IRA, Roth IRA, there's no guarantees. The market go to zero, you could lose it all. Free of regulations. No percentage-based fees. There are fees in life insurance. So this, in theory, this is why it says percentage-based fees. You could think of this as yellow. There are some upfront costs, whether it's commissions to the agent, cost of doing business. You don't have dollar for dollar right away up front, and we'll look more at an example from that. But from a 401k, you start taking 1% per year on your account, that can add to hundreds and hundreds of thousands of dollars, if not millions at some point in time, depending on how large it can get when you're looking at some of these accounts. Free of regulations, again, life insurance, it's its own separate category. It's not an investment. Regulations are way different. Contribution limits, 401k, Roth IRA, your income and the amount you can contribute are limited. People contribute millions and millions of dollars a year to life insurance. So that's one incredible advantage and why wealthy people use it. Wealthy people can't use their Roth IRA, right? And you can only contribute like 18, 19,000, like the number changes to a 401k, so it's different. But you can contribute hundreds and hundreds of thousands, if not millions of dollars to your life insurance policy. Creditor protection. If you get sued, there's a lot of cool protections that are in place. There is in for 401k Roth IRA as well, but for life insurance, it's going to be very state specific. Here's an example: Florida, unlimited protection per that state. Some other states may not be as advantageous. Some provide $250,000 of protection or $15,000 protection. We have a sheet that says all of the states that and the amounts that they are protected by. So if you want to know, reach out. We'll go ahead and send that to you as well. Deductible contributions, 401k, you essentially, dollars go into the account before you're getting paid. That is deductible at the beginning. Roth IRA, savings, life insurance, you pay the taxes, it goes to your bank, and then you go pay the Roth savings, or contribute your Roth savings or life insurance policy. Now, there are other things that you can do, like you can, if you talk to your CPA, when you borrow against your life insurance policy, you can actually write off the interest when you do it right, when you're doing it for business or investing, other opportunities like that. So that's another deduction that you can do, but that would need to be worked out with your CPA and doing it well. Tax-free growth, tax-free use, just the tax advantages, right? Because it's life insurance, the umbrella, you don't want to tax the widows, don't want to tax the orphan. Like, the life insurance is set in place to help people pass away from death. But because that's the case, there's a lot of really cool tax advantages that come with it when done well. And then the death benefit, of course, right? That we all know of. When you die, you pass away, you have a death benefit. And the cool part, when you look at this, is none of these have the death benefit, which to me is actually a very undervalued asset, because it gives you a lot of options. It gives you the option to spend down your money today, knowing that you have something significant that you want to pass down to the next generation, right? A lot of people are, well, I can't spend my money today sometimes because I want to pass some of that money down. Well, this is the concept of the and. It allows you to do both. It allows you to have the flexibility to be able to spend your money today and be able to pass down a large lump sum to your family as well. And so here's a very powerful concept that's essentially thinking of like maybe the volatility buffer, which I'm going to explain right now. But long story short, it's called the powers of two, where if you have an investment portfolio that's 100%, you will actually, there's a really, really high likelihood that you will run out of money in retirement. Studies have proven and shown that when combined with life insurance through studies of PhDs, time over time, tests, that when you implement life insurance with it, you will have way more money and accessible money throughout retirement because you can utilize your dollars in downturns because it's growing, it's safe, it's protected. A lot of things may happen that gives you the extra protection needed to be able to have flexibility. You could use it in the worst times of your life, knowing that it's there. And when the market gets cut in half, I don't have to stress of like, oh, I need to actually use my investment account from fund my lifestyle when I'm in retirement. And that's probably some of the biggest downfalls. If you look at people in 2008, they had to go back to work because their 401ks and retirement accounts got cut in half. If you bought in to the market in the 2000s, some of the peak, it took all the way back to 2013 to almost like break even again. And that is tough for people that are in retirement. But if you have a system where you have life insurance as well that allows you to use that income instead of your investment income, and then when things recover, you can start using your investment income again, it'll allow you to have more income into the future and, hopefully as long as you last. There's also other cool benefits, chronic illness and accelerated death benefits. So, if you get sick, cancer, heart disease, like some of these things, you can tap into your death benefit to help you live longer, to pay for some of your medical bills. So this is where the Swiss Army knife, right? We've talked about already the death benefit. We've talked about the tax advantages. We've talked about the control. We talked about the growth. We talked about these benefits right here. There's so many benefits that come to having life insurance as an asset versus just focusing all your money on just growth with risk that's involved. Again, I want to overemphasize the phone concept. I think it's just an incredible way to position and think about it. You have this bundle, right? Just kind of think of the phone as the and asset. And inside of the phone, you have all these apps. And inside of the life insurance, you have all of these of different characteristics and things that it can be used for, just like the phone is used for many different things. So this is at the very beginning, some of the things we talked about. We just talked about a lot of the multi-dimensional benefits. And I think that was the key focus of that section was a multi-dimensional and asset, lots of different ways that it can be utilized. And so now what I want to do is I want to talk specifically about the overfund versus typical design. So what you're used to seeing in life insurance is you have a term insurance where you pay for 20, 30, 10 years. When that runs out, that's $25, $50, $100 a month. That runs out, you essentially have no money and you don't have any more protection, right? Or if you die within that time frame, that money gets paid out to your beneficiaries. Cool, we all understand that. Then there's the permanent side of things. And the permanent side of things is there's lots of different policies. Okay, you could talk about whole life insurance, index universal life insurance, variable universal life. We're going to specifically talk about overfunding. So mainly we'll just use like whole life insurance as the foundational asset around this. And it's the permanent side where it actually builds up cash value where you can borrow and utilize it while you're alive today. Well, and you hear the Dave Ramseys of the world talk about whole life insurance being a scam. It's because they're used to the typical design, right? Dave Ramsey has seen lots of insurance policies and design in a way where it is typical, and that provides no cash value, no flexibility, and just an extremely expensive death benefit. And when he says like whole life is expensive, in that concept, it really is. And I agree with Dave Ramsey. So when he says it's a scam, I actually can't argue with him. I actually agree with him in a lot of senses. So what we're going to talk about today is we're going to talk about the overfunded side of it and how powerful that is versus the typical side. And so we have to be very specific when we're choosing to write one of these contracts, because that's what it is, we have to pick a very specific insurance company as well. You can't just go to a State Farm or a stock company like a Nationwide or some of these other companies, Prudential, that are saying, hey, we want this overfunded whole life concept. Not every company is created equal when it comes to this concept. So you have to know which companies to use. And there's a very small bucket of them. I would say there's probably even like 10 that I would even consider writing a contract like this specifically for the use case that we're talking about today. So you have your person, which would be you, your insurance policy, you write a contract to the insurance company, and you're essentially saying, I'm committing that if I pay my policy, you will essentially pay a benefit. And there's a big difference between, again, we talked about a mutual versus stock company. Stock companies are very heavy on dividends to the owners of that company, right? When you pay a dollar and buy stock, you're now an owner of that company. Well, the dividends go to the stockholders. But you want a mutual carrier when it comes to this concept, because if you're a mutual company, those dividends then go to you as the policy holder. And so when you buy a life insurance policy with these mutual companies, you are an owner in theory, and you're mutually connected. And so the benefits, you get benefited by having your policy there, and now the dividends come to you instead of the stockholders. Rating is super important. We only want to work with A-rated companies. Comdex score, which is a scale of 1 to 100, like how financially strength and reliable they are. They need to be a 90 or above, in our opinions. Some people argue that you can get in the 80s, sometimes 70s. Not for us. We really want to stick in the 90s. It's very important that we have strong financial backings. These companies have a long track record. They've paid dividends through the great financial crisis, Great Depression, any type of sickness, black swans, anything like that. We want to, if they have proven that they've been around to be able to pay these dividends and have never missed a payment. And all the companies we use have never missed a payment. They've been around for hundreds of plus years. So again, I've already shared a little. It's, you have the contract. Talked a little bit about term versus permanent. And so now what we want to do is we want to talk about the special type of life insurance that I just talked about from the overfunded versus kind of the traditional. So what we want to do is, in this concept, we want to maximize the living benefits, right? What we're used to in insurance is we're used to just maximizing the death benefit and maximizing the death side. And I know a lot of people don't get too excited about paying money into this to a system that they never get a benefit from, and just this large lump sum of money that's paid out and not getting utilized anything today. And so the whole concept of this is maximizing your living benefits today and actually decreasing the death benefit, the death payment to your beneficiaries to as low as possible without there being tax consequences involved. And that's a super important thing, where you need a specialist to design it in a specific way to maximize your living benefits and minimize your death benefit without essentially causing what's called a MEC, a modified endowment contract, which is why you must work with a professional to do this in the right way when you're designing it for this concept. So here are the pros, right? You got your safety, liquidity, lifetime growth, leverageable. Like, these are all the things we talked about in that list of like red, green, yellow that this concept has. And then your cons is, I think it's important that you always talk about the cons, right? You can't talk about the pros only and then never talk about the cons, because if you just do the cons or the pros only and never talk about the cons, it seems I think unauthentic and you're not transparent enough. But again, you can't deduct the contributions, right? Those won't be deducted from your taxable income. I did share that there are ways to get deductions within that if you're using it for business or real estate or investing, and you talk with your CPA and document in a specific way. Break even, that's essentially saying, hey, dollar for dollar access, right? I don't get all of my money back, or I can't utilize, this is a better word, I can't utilize all of my money that I put into it until about 4 to 7 years, depending on the design, the contract, and the company, right? If I put $100 into a bank account, I can take that $100 back out. If I put $100 into life insurance, I may only be able to use $70 of that within the first year, and then that'll go up more and more. And then by years 4 to 7, if I put in $100,000 over the 4 to 7 years, I could get access, utilize all $100,000 of that. And you may be asking, well, why would I want to do something like that? Well, it's all these other things that we're talking about. It's safe, it's liquid, you can leverage it. There's protections, there's tax advantages. We talked about the IRR of like, okay, long term you can get 4 or 5%. In tax equivalent, it's closer to 10%, which we'll talk more about. But the other downside to this is like everybody doesn't qualify, right? You either be too old or your health doesn't qualify. It's not something that you can essentially get. Now, there are other solutions that if you are unhealthy or to a disqualification perspective, because there are levels to health where even if you have health concerns, you still can get it. It's just how unhealthy. And then from an age perspective, we can also get life insurance on other people. So you can get it on your spouses, your kids, generationally planning. You can do that as well, grandkids. You can get it on your employees. You can get it on business partners. You can get life insurance on pretty much anybody that has an interest. Essentially, if you die, something drastic can happen to them. From a financial perspective, we can easily qualify them as being able to get life insurance from that perspective. So with that being said, let's talk about the typical versus the typical or traditional. We can use those words as synonyms versus the overfunded part. So when we look at this, okay, the left column is the amount of money that we're putting in per year. So $50K every year. The middle column is the amount of cash that you actually have available to use. And this is what people are used to seeing. I put in 50 grand, I have $0. I put in another 50 grand, I have $0. And by year 3, I put in $50 grand, and I now have 25 grand. So I put in 150 grand, and I now have 25 grand. So this is what Dave Ramsey says is like, it's terrible. You have no money. You get, maybe 1%. And, you're looking at this. It's like, well, I don't get even 1%. I'm getting 0% growth. That's actually negative infinity the first couple of years. And then your death benefit is almost $4 million. But this is a plan that people could use specifically for like estate planning, where they need maximum death benefit as much as possible to pay off taxes for a high estate. So life insurance is a great play for estate planning and needing help for paying taxes and other things like that for extremely wealthy people. And Dave Ramsey talks about that all the time. He talks about like, hey, unless you're extremely wealthy, like this isn't made for you. And this design that you're seeing is made for those people, just like he said. So I couldn't agree with him more when he says like whole life insurance is made for that. And I agree right here. But there's another side that sometimes he doesn't mention, or, either he sticks to his brand too hard. And so he just, ignores it or doesn't know the full facts. But what we call is the max funded design, or the overfunded side. And so when you hey, amazing. Well, we got the master over here that's looking out. Okay. Okay. Can you see it now? Okay, let me go to the view slide recording slideshow. Okay, can you see the typical versus max funded design? Okay. All right. So I'm just going to try to say this in. Like I just talked about the left side, that you may not have seen the numbers at this point, but now you do. So left side, cash value, 0, 0, 25, Dave Ramsey, boom. Okay. And then I'm going to now say, okay, now we're going to talk about the right side. Okay. And now what we're going to do is we're going to talk about the same design, different design, but with the same company. All right. So just know that. This is why not all life insurance is created equal, is that it's important that we're using the companies that we recommend from, high ratings, high financials, been around for a long time. That's important. And because to facilitate this concept, but also somebody, even if you choose the right company, you can design it completely different and you can get a completely different result. And so what we're doing here is we're seeing this right side is $50,000 going in, just like the left. But instead of year 1, there being $0, you now have almost 40 grand. And in year 2, instead of there being $0, you have 82 grand. And then year 3 that we discussed, 25, you actually have 132. So you can see the massive difference in regards to the amount of cash value the cash that you can actually utilize and borrow against for any activity, whether it's an emergency fund, whether that's investing, whether that's real estate. It's a massive difference between the two. But the thing that you see is that the death benefit is also really, really drastic at the beginning. You have 3.9 million versus 1.3 million. And that's where the difference is. Again, like we mentioned, we want to lower and minimize the death benefit as much as possible. And we want to maximize the cash piece of it. On the left side, for estate planning and traditional, you minimize the cash value and you maximize the death benefit. The ironic part about this, though, is if you fully fund it the same amount, if you look at the very last line, there's 2.7 million on the left of cash, and there's 3.2 million of cash. So there's still like a $500,000 difference in regards to the amount of cash from the left side to the right side, but the death benefits are pretty much equal. There's only a $20,000 difference, and that's the powerful part about this concept is you pay in this for a long period of time because it's so much money is going in and it compounds. The cash value grows so rapidly. The death benefit also has to increase to keep up. So therefore, the policy doesn't MEC, which is a taxable event that I mentioned a little earlier. And by doing so, the death benefit actually grows faster than the total death benefit on the left side as well. So you actually get best of both worlds when you fund this for a long period of time. So this is the magic sauce behind what we call the and asset, the overfunded whole life insurance, the two massive differences in creating, not all two policies are the same. And the other part is from a flexibility perspective. This left side, you are forced to pay 50 grand every year. Like there's no if, and, or buts. And I know some people, they don't like that. So on the right side, you could pay 50 grand, but if you ever get into a pickle financial situation, you can get as low as, depending on how we design it, probably close to like 5 to 10 grand would be your minimum contribution that you have to pay a couple of years in a row, to where you get your feet back together, cash flow increases again, and then you can pay the 50 grand again as well. So there's even a massive flexibility around it too. All right, so we did talk about a little bit about the typical policy, right? We're just looking at it from a numbers perspective. And so like now what we're going to do from a typical perspective, we're just going to explain the integral pieces of it. The typical side is a high base, which is essentially the cost of insurance. It's the mandatory amount. So I said like the 50K. That is the mandatory. So base, just think of cost of insurance is extremely high. Little to no cash value. We discussed that already. Not flexible. We shared that as well. Like you're forced to pay the 50 grand, and then takes 10 plus years to break even. Like if we look back, like when do I put in, year 3, we put in 150, we only had 25. Well, when do we finally get all of our money back, right? 10 years is very generous. I have seen policies that break even year 25 with typical traditional, right? It's 10 is giving the benefit of the doubt to something like this. And I want you to know, like, I'm not trying to degrade the typical policy. I think that just people don't know about the overfunded policy that we're referring to. And I think it's important that people know what's out there and their options. And if people want high death benefit, great, then you can get high death benefit. But if people want high cash value to be able to utilize while you're alive, that's what essentially you should get and receive. The other reason why I think agents sometimes, there's two things why agents don't talk about the overfunded one is twofold. One, they may just not know, and I'm empathetic to that as well. There's actually 3, and I'm going to assume the third is never the issue. 2, you just get paid more, right? And so therefore they kind of lean towards that a little bit as well, like their bias is that. And then 3 is kind of a combination. It's like, okay, I know there's a better way, and I know I get paid more, so I'm intentionally selling the one that I'm going to get paid more, and I'm okay with that. People have to feed their family, I understand, but for us, we want to do what's ethical and what's right. So what we do is we ask you great questions, we figure out what you really want, and then we design a policy that's tailored specifically for you. And a lot of the time, it's not atypical because we're helping entrepreneurs, business owners, people wanting to save for retirement, real estate investors, people that want cash and liquidity to be able to use and borrow for other activities. And so this was the design that we mentioned a little bit earlier of 50 grand, all base, traditional. This one was a 12 years. And this is because we, did it with a well-represented, reputable company. And the specially designed one, which is overfunded, max funded. There's different terminologies for it. Essentially, what this means is our base is really small, the cost of insurance, and we put other riders on there that make it essentially fancy to allow more cash to be shoved in to be able to utilize. And those things are called PUA riders and term riders, things that may go over your head, which is actually okay. But this is where the flexibility comes into play, is where you're forced to play the base, right? So if I have a huge base, I'm forced to pay that. The PUA riders and term, those things are a little bit more flexible, and per company, you can pay none of it. You could pay some of it. You could have multiple years not paying it. You can pay it at any time throughout the year. You can almost treat it like a bank account to some degree with how you pay. But this is what produces the magic sauce, is having a PUA rider on the policy to be able to utilize. So then you also have, again, you have already seen it, a lot early cash value, more flexibility, better long-term performance. These are all the things that I just mentioned using a visual, and now you can see it from our words. And yeah, pay, like I said, you get paid a whole lot more when you do the traditional all base. Depending on the design, depending on the size, you can get paid 1/10, which, 25% of it. Like, it really just depends, but I have seen it where you can get paid 1/10 depending on the design and contract. And again, break even on this one, 50 grand every single year. This is the specialized overfunded. Instead of it taking 12 years, you get all your money back in 6 years. That it's half the time. Imagine the lost opportunity cost of all the money that you lost, or what you could have used that money for to grow your wealth and build it as well over that period of time. So again, those were some key differences between overfunded versus typical. And now what we're wanting to do is just talk about the main benefits, in my opinion. Again, so you as a human, you're your number one asset, right? The skills you learn, the things you do, the actions you take, your job, your mindset, your spirituality, all of those things, you are your number one asset, right? So you want to invest in yourself. And so it's like, where do you put your money to essentially be the best version of you? Well, if you want to be the best version of you and you want to use your resources well, it's probably the thing that gives you the highest rate of return, not on your dollars, but the rate of return on yourself. That gives you multiple benefits, like the Swiss Army knife of financial products, such as life insurance, right? These does all these things. How's you protect for your family and also pass down generational, save more money for today and for the future. It does grow still. You have control over it and gives you future cash flow for whatever reason that you want. Lifetime growth, right? That's obviously super important that we talked about. And then tax-free compounding lifetime growth, I think, is the thing that people have a hard time wrapping their brain around when it comes to this concept, because people are so used to putting your money into a 401k, you pull money out, putting money into a bank, you pull money out, right? And that's normal. We understand that. When it comes to this, it's slightly different. And this is where I want you to think of it more of like, when it's set up and used properly and designed a specific way, it becomes one of the most powerful tools because of this concept specifically. And this is where, whether Albert Einstein came up with it or not, he said compounding interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it, right? And essentially, there's this curve. At the very beginning of all compounding interest, you have very little growth, right? But the longer you have it, the more profound that it gets as time goes on. So you essentially can see that, I have amount, interest, and time. Those are the three things that make up compounding in general. And so if you have a lot of money going in at a specific interest rate and a lot of time, you will create a massive amount of wealth, regardless of what it is you're doing. But when you interrupt that and you take money out of it, so if I have a bank and it's, let's say you're getting 4%, right? And then, you put money in every month and then you take it all out and you went compounding and then you pulled it out and utilized it and now it's gone. Well, you no longer have that money anymore. Same with 401k. You get to retirement, you're 60 years old, you saved up all this money, you compounded over the last 30, 40 years of your life, and now you get there and you stop the compounding. Why? Because you're now taking the money out of that account. And when it comes to life insurance, it's actually, I want you to actually think of this, come back to this slide. Think of it as a compounding slope that never stops, Why is that? It's because we're not actually taking money out of the account. We're not actually withdrawing money when we utilize this the right way. To get the tax advantages, we leverage it and borrow against it. So think of it like a HELOC or even like a credit card, where you have a revolving line of credit and you utilize that. And you get to utilize the money and then you could pay it back. You utilize the money and pay it back, but you're borrowing the money from the life insurance company. So your dollars is set as collateral. So think of your house, that's set as collateral, right? Think of the life insurance policy is set as collateral. When you get a HELOC, you can utilize that line of credit, and that line of credit can increase if your property value also increases. Well, you don't know if your property value is going to increase or not due to the sheer art of housing crashes or, just where you live, location, know that your life insurance policy will always increase and your line of credit will always increase and keep using and compounding no matter what. And when you borrow and utilize your HELOC, that doesn't limit the asset of your home actually growing and increasing. Same with life insurance. Just because you're borrowing and utilizing your life insurance policy doesn't limit the growth of the policy. So you actually have the growth and interest in time that keeps growing while you're also utilizing it today. That's why you get the access to the living benefits, lifetime compounding, unlike any other financial products such as like your 401k, so on and so forth. And then here's the math behind it, like for an IRR, which is why I think it's super important. You don't get dollar for dollar access right away. If you put in 50 grand, you only have 40 grand. Like in theory, it's actually a negative 20% return, right? I think that's important to know. But you still have access to all 39K to be able to utilize. And let's say you took a loan for 30 grand. You don't have just 9K compounding anymore, right? You still have the full 39K compounding that's actually still growing. But if you do utilize 30K at that point in time, you only have access to 9K of it. Then you make your $50,000 premium. You now have $82,000 that's in there that's compounding, right? You still have your loan that is accruing interest. That is important to know. It's just like anything, your HELOC, credit cards, like they all have loan interest, which is actually some of the lowest loan interest rates in the entire financial system, which is amazing. And then it just continues to keep growing and compounding over time. You put this into the future value calculator, over 30 years, you're roughly getting around 4.58%. This will be different depending on age, design, company. And so then you have to ask yourself, well, what do we compare it to? We've talked a lot about the 401k. We've talked about other financial products. When you start looking at it from taxes and management fees and other things like that, just looking at the tax rate of a 30%, right? When you're 401k, you get to 60 years old, 59 and a half, you start taking, you got to pay taxes on it. Well, your actually equivalent rate in life insurance is closer to 6.43% of an actual rate of return when you're looking at it. And now you add a 1% management fee, you're actually getting close to 7.5%. And then you take term insurance, right? If you're, younger and you're wanting term insurance or even older, right? You want to buy term insurance. That term insurance is going to eventually run out. But what could you have done with that dollar? If you're paying $200, $100, $50 a month into term, what could you have done with that dollar to essentially grow your wealth? You could have put it into the market. You could have put it into Bitcoin. You could have put it into permanent life. You could have put it somewhere else, but instead you just lost it. So it's important to factor in that as well. And we talked about this from the compounding perspective. I think this is a good example of like, hey, the curve, you can see once you get to the age 65 of how profound that curve actually gets. It starts to become super steep the older that we get. In the earlier stages of life, it's not as profound. And so like, why do we want to kill the goose, right? The goose is the compounding interest that's laying the golden egg, the interest on it that's crushing, right? If we start spending it, well, now we're killing that goose that's producing the interest. So we don't want to kill that at any point in time. We want to have the ability to have that grow and compound for the rest of our life, which is why we utilize life insurance. It's just like these, you talk about like Michael Saylor, and he's talking about Bitcoin, and these really wealthy people. They don't just do this with life insurance, right? They essentially get stock, and they have these stock invested in these companies because they own part of the company. They're not selling their stock when they want to use it. They're just borrowing against it and for collateral. It's like Elon did the same thing when he bought Twitter. He borrowed against it as collateral and then utilized the money, got a loan, and then now he has Twitter, right? He's not actually killing the thing that is the asset. And that's why we have to think about how do the wealthy operate, and is there ways that we can utilize it even in today in our system and what we have access to. Again, we talked a little about that, the small versus the massive amount. And, we don't want to cut it off at that point like we do in most 401ks. So in controlling use, we talked about this and the power behind it. Again, we're utilizing it for a loan to grow. And then, this is really where people fight their battle of like, do I have it compound in a 401k or do I keep it in control inside of a savings account, right? Well, is there a world where you can have both? Yeah, like we've talked about it already. Life insurance, and it's kind of the concept of credit versus debit, right? Credit card is that evolving line of credit. Like once you use it, you can pay it off. You could use it again. Debit, once you just pay it, the money's gone forever, and you no longer get to have that ever again. There's some pretty cool case studies as well. We even have some videos like I talked about. We have an Andas YouTube channel, a Better Wealth YouTube channel. This is my partner and a colleague of his, where they talked about how a good friend of ours made 3,000% investing into cows using life insurance. Because again, you're borrowing other people's money. And so this is really a great way to think about it. You're your number one asset. You have opportunity fund, your emergency fund. You can use it for whatever, investing, real estate, business, and having a piece of it as an emergency safety, whether it's 3 months, 6 months, whatever it is for your family from an expense perspective, it's always great. And then you could take everything else and you can invest it into some of these other assets. It's a great way to build wealth. So you ask yourself, when does it make sense to borrow? Usually it's better to borrow when your activity that you're going to go produce, whether that's real estate, investing, your business, is greater than the borrowing cost. And so we call it the control cost. And so here's kind of the concept. You deposit 1% into the bank. This is kind of I would say relatively old-ish, because obviously you're getting more than 4% now, but it's because banks can go get higher in certain rates, such as like bonds and things like that. But there was times where you were getting only 1% of your money, right? So you put 1%, your money in a bank account, they give you 1%. They give you that ability to use that money. So they're paying you 1% to keep your money there. It's like the dangling carrot. So you get safety, control, and we'll pay you 1%. And then they'll go take their money and they'll go loan it out and get 4% somewhere else. Well, it sounds like there's a 3% delta on that, right? But in reality, it's a 300% delta, because 1 to 2 is actually 100%. So 1 to 4 is 300% in actual dollars, right? So it's actually a pretty profound return. So here's some examples of like, hey, what I want to or what I not to. Well, my borrowing rate is 5%, but my investment is 2%. No go, you get negative 60% return. 5 to 5, still probably not a good idea. Now you got 5 to 7. You can consider it's like, okay, now my ROI is 40%. Some people still wouldn't take this because they feel like when you spend $1, even when you're using it, even in life insurance, if I take a loan for $50K, that's the max that I had. Well, now I no longer have that to be able to use for another opportunity. So sometimes people are like, well, the opportunity's got to be great enough for me to be able to utilize it. And then it's like, hey, 5 to 12. Some people will still say no to this as well. Everybody's investment risk tolerance is going to be different, but this is an example of like when you'd want to, like red, white, green, so on and so forth. So again, we talked about emergency fund and opportunity fund, overemphasizing what this can be used for. And so when it comes to future planning, retirement, this will enhance your cash flow regardless. And I think that's the one thing that remember that's super important. And then here's some other benefits that we have, and we'll just touch over a little bit more. Obviously, you get the death benefit, the volatility buffer we talked about at the beginning. When the market's down, use your life insurance instead of using your asset-based accounts that's already down. Covered asset strategy. Just think of this as like long-term. You essentially have the ability to get a policy today for future income to maximize your pension. So that there's strategies around using life insurance as a future pension, reverse mortgage, lots of incredible things that you can do when you have life insurance, because it gives you the permission to spend down some of your reverse mortgage strategies, future tax shelter. We talked about some of that as well. And then, being able to pass down a large lump sum to your family. How will they remember you? Were you there for them? Did you, think about them when you were here on this earth? Because that's what they'll think about a lot of the times. Like, hey, how did you show up as a parent and as a spouse? And obviously how you showed up intentionally day to day is important, but also how did you leave them when you passed too is important. So in estate planning, we talked about that. There's a lot of really cool things that executives done. Enron executives are still getting paid today for their pensions, which is kind of crazy because they obviously did a lot of illegal things. And then here's some other benefits to life insurance that inside of it. We talked about the chronic illness rider, accelerated death benefit. There's waiver of premium, which is essentially saying, hey, if I get disabled, I can have a portion of my premiums get paid for. Child riders, essentially, if your child passes away, death benefit piece of it can get paid out. And then if you set this up well, does it give you the ability to save more? The answer is yes, right? Because it's almost forcing you to make contributions, which is also a good habit on an annual basis. And again, you're your number one asset. How do you want to show up? Will this concept give you more flexibility, allow you to show up more intentionally? My bias is yes. I can sleep better at night showing up that I have protection for my family, that I have a safety pool of liquidity, that I have money for opportunities, that I have tax advantages behind it, that I have all this stuff for the future. And I get to choose today and also into the future and not have to say no today, because it's an and concept. And so again, you want to give your dollar more than one job? right? This is it. And this is where we came up with the and asset and giving your dollars as many jobs as you possibly can. So in summary, it's the and concept, which is greater than the or concept. You know, a lot of investment vehicles is or. This is the and, which is greater than, in our opinion, which is the and asset book. And, you know, B is in better. We are Better Wealth, betterwealth.com. And I think that, you know, we've decided to try to find a better way for people to utilize, store, grow, protect their wealth, to live them intentionally versus the traditional financial planning side that has proven over many years that waking up, getting a job, doing it for 40 years, trying to find the pensions that don't exist anymore, putting in a 401k, and then say that you're going to be able to retire at this stage of our society is a fallacy. And I think people are waking up to that. And we're trying to be a forerunners to helping people see that and give them a better way to utilize their financial resources. So with all that being said, thanks for sticking around. I know the presentation was kind of long, but hopefully it was worth it just from an education perspective. Hopefully you learned a lot. We're here to answer any questions for you. Next steps, reach back out. If you're getting this through email, reply to this email, reply to Gabriel and say, hey, I really enjoyed the concept. I really want to talk to somebody on your guys' team to connect, to learn more, to get your own personalized illustrations for you, to talk to somebody on the team to help you see if this is right for you. To be able to just have a conversation to get the ball rolling on next steps on, okay, where are you at? Where are you at financially? Is this the right time for you? What would this look like for you and your family? How much do you want to contribute? All of those things that we have experts on the team that will help you with that. And we also will provide you with the free book if you reach out and ask. And so with that being said, super grateful for the opportunity to be able to speak to you guys. Let us know if there's anything we can do to help, and we'll talk to you soon. See ya. Okay. What do I...